On May 1, 2026, the global energy order shifted. The United Arab Emirates, a founding Arab pillar and the world's seventh-largest producer, is walking away from OPEC and OPEC+ after nearly 6 decades of membership. To many investors, the news looked like a non-event because oil prices barely budged. But that stability is a geographic illusion. Because of the ongoing Iran conflict, the Strait of Hormuz is effectively blocked, meaning the UAE's oil is trapped, regardless of their membership status. This quiet market masks a collapse of the collective hedging policies that defined the entire Middle East for 60 years. Abu Dhabi is discarding strategic ambiguity in favor of a singular, independent posture. By exiting, the UAE is throwing off the cartel's requirements to pursue its own strategic goals. They are no longer willing to let a committee in Vienna dictate their national revenue. This move strips the oil market of its primary safety net. Without the UAE's coordination, the world loses a critical buffer against supply shocks, moving the energy market toward a period of structural price volatility. This chart shows the friction. The UAE spent billions reaching a capacity of 4.85 million barrels daily, yet OPEC caps output near 3.2 million. This restriction costs tens of billions. With ADNOC targeting 5 million by 2027, the gap between potential and allowed sales widens. Sultan Al Jaber's strategy at ADNOC is clear. The UAE must monetize their oil reserves to fund their transition to a knowledge-based economy. They are racing to extract value across the world before global demand for fossil fuels begins its long-term decline. This creates a direct rift with Saudi Arabia. Riyadh needs high oil prices to sustain its own domestic spending, which requires strict production cuts. Abu Dhabi, however, needs high volume. The fiscal requirements of the Saudi price defense strategy cannot coexist with the UAE's drive for market share. One state's growth requires the other's restraint, turning a decades-long partnership into a fierce competition for regional dominance. That competition is visible in every sector, from the fight for foreign investment to the race to host corporate headquarters in cities like Dubai. The economic pressure reached a breaking point during the Iran conflict. When Iranian missiles hit Emirati territory, the UAE absorbed the damage of a regional war, while its allies remained sidelined. Emirati officials described the response from the Gulf Cooperation Council as miserably weak. For Abu Dhabi, the crisis proved that regional security alliances were no longer providing real protection. This is Treasury Secretary Scott Bessent, who recently backed an emergency dollar swap line for Abu Dhabi. The UAE is building a new bilateral security architecture with Washington and Israel, including the deployment of the Iron Dome on Emirati soil, an architecture that exists entirely outside the OPEC framework. Remaining in an economic cartel with Iran, the nation currently attacking their soil and blocking their oil exports, became politically impossible. Collective restraint was effectively subsidizing an adversary. The UAE decided that the legacy institutions of the Gulf were a liability. To protect their sovereignty, they had to formally end their 59-year tie to the cartel. The mathematical fallout is immediate. With the UAE departed, OPEC's global supply share drops from 30%. If the market becomes oversupplied, Riyadh will have to cut its own production even deeper to prevent a price collapse. Without the UAE's coordination, the cartel's ability to set a price floor is compromised. The global market is now exposed to wider, more frequent price swings. There are 2 paths forward. In a bull case, a smaller, more unified OPEC survives by cutting output aggressively to defend prices. The bear case is contagion. If other producers like Kazakhstan follow the UAE's lead to capture market share, the average price of oil could crash while volatility reaches new highs. For energy investors, this shifts the risk profile. Low-cost, trading-oriented oil majors will likely benefit from the chaos, while high-cost producers will struggle with a lower price equilibrium. The fragmenting of the petrodollar system means oil is no longer a coordinated, dollar-stabilized commodity. As the link between OPEC coordination and global currency stability fades, traditional risk correlations are breaking down. Because oil has lost its primary shock absorber, it can no longer act as a reliable hedge against global instability. Investors must shift toward assets outside a broken cartel. In this fragmented order, gold becomes the primary asset capable of absorbing pure geopolitical volatility.